This is Intelligent Investing presented by Fidelity Investments. Inflation is a big worry for the stock market. It eats away at corporate profits and could force the Fed to raise rates faster than it's currently forecasting. After about 35 years of generally falling inflation, signs of an uptick has unnerved investors. Inflation expectations have been climbing and have been showing up in recent wage and consumer price data. According to a recent research note from Fidelity Viewpoints, there are 3 key reasons to consider inflation risk. Number 1, inflation eats away at future purchasing power. All my dad ever wants to know is that he will be able to buy the same number of hamburgers in 20 years that he can buy today, and that is pretty much his entire retirement plan. But when inflation rises, my dad can buy less hamburgers in the future unless the return on his portfolio is higher than the rate of inflation. But according to research from Fidelity, stocks and bonds don't perform well in periods when inflation is rising for an extended period of time. This chart shows the real annualized return of U.S. stocks and 10-year treasuries from 1935 to 2015, when inflation is falling for long periods of time versus when inflation is rising for at least 6 months. During periods of falling inflation, real annualized returns for U.S. stocks was 14%, and 10-year treasury returns was about 4%. When inflation is rising, real returns plummeted for stocks and bonds. Finally, higher inflation increases correlation between stocks and bonds. For the past 20 years, when inflation was relatively low and stable, growth had a greater impact on stock performance and bond performance, with stocks being positively correlated to growth and bonds are negatively correlated to growth. But when inflation is higher and more volatile, like it was in the 70s, the correlation between stocks and bonds increases because rising inflation negatively impacts both stocks and bonds. This all means, according to Fidelity, diversification beyond mainstream asset classes is important when inflation is rising, because not only are stocks and bonds more correlated, they also historically have lower returns. Consider diversifying with asset classes that outperform when inflation is rising, such as commodities, commodity-producing equities like energy and material stocks, or gold.